All right. Welcome, everybody. Welcome, welcome. And while everybody filters in, there's usually a little bit of period where, Zoom allows you to kick on. We've got a little trivia question for you. And I will give you the answer. You don't have to come up with the answer on your own, but you can take a look at the scenario over my shoulder here and think about. You don't have to get out a pen and paper and do any number crunching. But think about what this should look like in your head, and I'll go through why it's a little bit trickier than you might think. But welcome to our tax webinar for the year. And this, as I will say many times throughout today's presentation, is coming from someone, me, who is not an accountant. This is not going to be how to fill out your taxes. I'm not putting myself out as authoritative on tax law necessarily, although a lot of investing and we're going to go through a lot of different topics today, touch on taxes, and I can absolutely provide advice as it relates to investments and how they might interact with taxes, but I am not an accountant, and I will say that many times. So don't hold this out as the advice you would get from an accountant. This is educational. We're trying to figure out or educate all of you and let you know that this is the stuff we think about. So it's worth thinking about on your end too. So without further ado, let's get started with our little brain teaser here, which there's a lot of numbers on the screen. There will continue to be slides with many, many numbers on the screen. I'm going to do my darndest to distill all of this into digestible bits. Not everybody is comfortable just reading a page full of numbers. I get that. We'll try to make it digestible here. Um, what the question that this brain teaser is getting at is asking is Bill is retired and has taxable income, blah, 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 includes blah, 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 blah. Those numbers are just numbers. But the difference, the thing that he's thinking about is I want to go on a road trip to, be a roadie for somewhere, I guess. I didn't write this question, but let's imagine he's a roadie, right? Um, he needs $1,000 to make this trip happen. And he wants, okay, I have the money in my IRA. How much is that $1,000 going to cost me in taxes, Anthony? And we look at his bracket and we say, well, he should be in the 12% bracket, so it should cost him 12%, so it should cost him $120. Let's forget about state tax for a second, though we know in Minnesota state tax is a thing, right? So how much tax is he going to owe? He pays 20, actually, that will put him into the 22% bracket. So he pays 22 cents on every dollar. So he should owe $220, right? That's what you're supposed to say. Yes, yes, Anthony, that makes sense. That's what he should owe. And then the answer is you're wrong. Haha. See, and this was written in ahead of time, so I knew you'd be wrong. No, he owes $407, 40%. Now, how can that be? How does he owe that much on just $1,000 taken from an IRA, which is just income taxable? Well, there's a few different things we have to think about, not just where your income taxes fall when we take money out of an IRA, or indeed any account that is pre-tax. So a deferred comp 457, this applies. 401k, annuities potentially have to think about this as well. And even non-taxable accounts, they're not taxed like income, but we still have to pay attention. There's a few little pieces as it relates to Medicare and Social Security, which is I'll go through exactly what happened here and why this how this is set up. But it's a Social Security thing that tripped him up in this case, and that's what somebody like me is watching out for you. So we're going to come back to this. I'll explain exactly why it was 407, 40% instead of 22% in a minute. But that was our quick little teaser. We're talking today about what this presentation, and I didn't make this presentation, but I think it's a very good one, is called the four phases of retirement taxes. Plan smarter, save more. Okay, that all sounds great, Anthony. What does that mean? Well, essentially, oh, and by the way, I haven't introduced myself yet. Again, most of you know me, but my name is Anthony Gerbi, Stein Financial Group. I've been an advisor with our group for over 10 years now, and a lot of experience, especially on the public employee retiree side of the equation. We work with all comers, don't get me wrong, but we really do have a specialty there. So I may speak to some of those unique things like pensions, for example, that not a lot of people have unless you worked for Hennepin County or for the state or for one of the other major governmental institutions that still does offer a pension these days. So With that out of the way, disclosures. Again, the main thing I need to disclose here is that I am not an accountant. So now we can move forward. And what today is going to be about is yes, we need to know how your investments and how they have what their tax implications are. And here's a great little, right next to me on the screen, a breakdown of that. But there are also a bunch of little things and Medicare, Social Security related that we really need to pay attention to because if you don't pay attention to them, they can kind of jump up and bite you or surprise you at the very least. And that's the last thing you want when it comes to taxes, right? You don't want to be surprised. You're lucky, I guess, if it's a surprise in a good way, but it's tax season right now. You may or may not have done your taxes yet. This is going forward, right? 2024 is already over, so there's nothing we can do about that tax year anymore. We're looking at 2025 and going forward. But people are doing their taxes right now, and I'm getting calls like, "Wow, we got a giant refund this year, Anthony. Isn't that great?" And I'm like, "Well, I'd rather get a refund than oh, that's true, but a giant refund? Like, how big are we talking here? Because if you're getting giant refunds, and I've genuinely had people who have had tens of thousands in refunds, um, that to me tells me we're withholding too much on your taxes, right? Somewhere along the line, it could be your Social Security, it could be your pension, it could be the money we're taking out of your accounts. We're paying in too much ahead of time, right? And on the flip side, every once in a while, I have somebody say, "Ooh, we paid in a lot. We owed a lot when we filed our taxes here," and that's not good either because that means we're not withholding enough. Um, don't make the mistake that happens fairly commonly, and I put the blame really on Social Security rather than any individual person. Don't make the mistake of turning on your Social Security and forgetting to do tax withholding, for example. And you might think, well, of course not, Anthony, but it happens. Believe me, it happens. And don't forget to withhold for state taxes too, depending on which state you live in. Most of you probably live in Minnesota. Obviously, we have state taxes. Don't forget about that. I have found just through, secondhand stories that the Social Security Administration is not great at sort of reminding you about that. So, if you're relying on them to make sure that that's going to happen for you, I would say we got to take the onus on ourselves to make sure that taxes are being withheld for us. So those are just a couple of watchouts just because we're in tax season right now and I'm seeing that stuff on a daily basis. But let me get back to what I'm meant to go through, which is what's on the screen here, which is I do recommend for people who if you're at all nervous about doing taxes yourself, I don't have any problem with people doing their taxes themselves, by the way. I do my taxes myself, at least my personal taxes. So I'm comfortable with people doing that as long as you're comfortable with it. Okay. And by no means do I think that working with an accountant or anybody, a tax preparer, is a bad thing at all. I do it because I'm comfortable doing it. But if you're in any way not comfortable, it's good to work with a pro. I really say that pretty much in all walks of life, whether it's financial stuff, house stuff. I could do a couple things around the house, but when it comes to plumbing or something bigger than that, I'm going to need to hire somebody to do it, and I feel good about doing that because I know they're going to do it right. Right. And that's what we want. We want it to do it right. So, a quick refresher. This is not meant to be a super long note here. Traditional IRAs, this would also be true tax deferred of your deferred comp. That's the same deferred in there, or a 401k if as long as it's pre-tax. When you take money out, you have to pay taxes on it. Pretty simple. Those are income taxes. A Roth IRA, when the money comes out, you don't have to pay any taxes on it, including the growth. So that one's very simple from a tax standpoint. Of course, to get the money into a Roth, you've had to pay taxes on the front end. So there's no free lunch there. And then finally, state taxes. Obviously, we're going to talk majority about federal taxes today, but a lot of the same principles can apply to Minnesota state taxes as well. For example, traditional IRAs, that income is taxable at the state level as well as the federal level. So people often pay more taxes in retirement than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. that's the one sentence version of what we're going to talk about today. And how do we avoid that? How do we mitigate that? What I'll say is the hidden taxes and penalties, they're not hidden like they're trying to hide them from you. They're just sort of in the fine print that it takes somebody like me or an accountant to help uncover for you. Hey, did you know that we're looking at this now, and this actually could impact you? And again, Medicare and Social Security are two of the biggest places where that comes into play. So you need to know what your after-tax retirement savings looks like. Okay. And we do this for you. So if you've done a plan with us or if we've looked at your numbers, we're already factoring this in. But if you have to pay taxes on your deferred comp, your IRA, your 401k, $500,000, let's say, in those accounts is not actually worth $500,000 in your pocket, right? For those of you who have taken money out from those pre-tax types of accounts, you know that one of the next question we ask after how much do you want is, do you want that after we withhold taxes for you, right? We'll withhold the taxes for you. That's fine. That's what we do. But to get $5,000, let's say from your IRA or a deferred comp account, you need to actually take out probably closer to 7,000 because with the tax withholding, that's got to come out separately. So, if you're married filing jointly, your $500,000 IRA could actually be as low as in the low 300s. Now, that's if you're in the very top tax brackets, and not a lot of people are. So, yeah, it might be more like 400,000. But if you withhold 20% between federal and state, which is pretty common, state taxes for most of us are going to be around 7% in Minnesota. And federally, it obviously depends on where your income falls, but between 10 and 20, your average rate probably falls into there. I think that's a majority of the people we work with. You're already over 20% right there. That means to actually, if you just took out $500,000 from that account and you withheld 20% in taxes, you're netting only 400,000 there. So remember, we got to take that into account when we think about how much money we have. The amount in your account is the pre-tax number. The amount that you get is after tax, and those two numbers are not the same thing. You might be thinking, okay, well, I'll have Social Security, and that'll help. But Social Security and Medicare, as I already mentioned, have their little tax traps, I guess you could call them. That makes them sound, again, a little more nefarious than they are. It's just weird little details that we need to pay attention to. Okay, so let's talk about Social Security, for example. This is the answer to that brain teaser I gave you at the very beginning. Why did $1,000 for this road trip come to a 40% tax bill? So a $400 plus tax bill for just $1,000 bucks. Why did that happen? It wasn't because he got kicked into a new income tax bracket. It was because he got kicked into a new Social Security tax bracket. Now, I'm not going to quiz you, but how many of you knew, just think to yourself, that Social Security is taxed at different rates, both federally and in the state of Minnesota, depending on where your income is? Right now, this is true. Now, the vast majority of you on here are going to be in the 85% bracket for Social Security. And no, that doesn't mean you're paying 85% taxes on your Social Security. That means only 85 cents of every dollar that you earn from Social Security is taxable. Okay? But if your income is lower, and not to say low, but just lower, and depending on where it falls, there is a 0% tax bracket for Social Security. If you're under a certain threshold for income, you could be paying nothing for Social Security taxes. And so what happened in Bill's case in this example here is that he was in that 0% bracket and he bumped himself into the 85% bracket. And so now all of a sudden more of his Social Security was taxable, and that extra $1,000 that he took increased his taxes much more than he thought they would. Okay. Now, we're talking a couple $100 of difference. Is that the end of the world for most people? Probably not. But why not save that? That will add up over time, right? And it gets even more stark, the examples, when you get to Medicare. So here's a little bit more example. This is why it went up a little bit more than the 22% that we expected it to. And the presentation is calling it the Social Security tax torpedo, and that makes it sound very dramatic. What it is just if I was Bill's advisor in this case, what I should be looking at is, ooh, are we going to kick ourselves into a new Social Security bracket by taking out this $1,000? If so, maybe we should look at getting that thousand from somewhere else that's not going to do that. Maybe like a Roth IRA, if he had one, for example. Those are the things that I think about when you call up and say, "Hey, Anthony, we need some money. Which account should we take it out of?" This is the process that I'm going through. So it makes a huge difference over multiple years to get this right and not have these weird years where you're getting these not even penalties, but just higher rates than you would have otherwise paid. So Medicare, I think Medicare is the even a clearer example. So you're going to see a couple times this acronym IRMAA, and I call it IRMA. That's what most people call it, just because to be frank, I don't even know what IRMA stands for. I know what it is though, and what it is did you know? And if you've gone to our presentations in the past year plus, you might have, because I do mention this occasionally, but did you know that where your adjusted gross income falls in a given year affects what you pay for Medicare? In other words, if you're over a certain threshold income wise, your Medicare premiums go up for the same coverage. And it's really punitive because unlike income tax brackets where, hey, if I go $1 over my bracket and go into the next one, well, it's only that $1 that's being taxed at that higher rate. Maybe that might be a good thing to actually, that's not in this presentation, but I want to go over that because not everybody knows that. Um, Tax brackets. Here are the 2024 tax brackets here. Did you know? I think a lot of you might have, but every once in a while somebody doesn't, and no shame in not knowing. This isn't what you do every day. When it says, okay, there's a 10% tax rate on 0 to $11,000 worth of income and 12% from 11,000 to 47,000. It's not that for income tax, going into the next bracket means great. Now all my income is being taxed at this higher rate. So I've really screwed myself by going $1 over. No, what it means is only the amount that you are over the next bracket is what's charged at that bracket's rate. Okay, let me make that concrete. Let's say my income, just like the example here, is $48,000 in 2024. Okay. That means I'm paying 10% on the first 11,000 of income, 12% on the next 35,000 and change, that difference there. And then on the last $1,000, that 40 from of the 48,000, that's what I'm paying 22% on. So I do find sometimes people say, "Well, oh, I don't want to go to the next tax bracket because then I'm going to pay 10% more, go from the 12% to the 22%." Not true. Only the amount you go over is charged that higher rate. So income tax, not as punitive when it comes to, oops, I went over the next bracket. I went over the next bracket above where I was. Um, Quick question. Is there a calculator available to calculate taxes based on moving through the tax brackets and going over each one? Yes, there are calculators available online. I was just poking around with one because I had a quick question that I wanted to just do a calculator, and I forget. Oh, which one I used. Tell you what, I will go and find one that I think is good, and I'll have Aaron include it in the wrap-up email, in the follow-up that includes the replay for this. Aaron, if you could make a note to remind me to do that, but I'll go find one because there are calculators out there. There's a million of them. If you just Google it, you'll find them. So that's one way to do it. But I will find one that I think is particularly good and I will make sure that's in the follow up just for people. Now, that's not the same as, it's a calculator. The calculators are generally going to be right, but if you just plug in what you plug in, that's all they know. So it's not necessarily going to be able to factor in all your deductions or the credits you might be eligible for. So grain of salt there, right? You're going to get an idea, but it's probably not going to be exactly accurate because to get the exact accurate number, you need to be able to show which credits you're eligible for. And do your deductions beat the standard deduction? We'll talk about that in a minute. So calculators are good, not perfect, is what I would say. Not that the numbers are wrong, they just don't see the whole picture all the time. Um, the So watch out now, getting back to this. Watch out for the Medicare IRMA cliff. Now here's the example of these people. They sell stock for $1,000. They owe $188, 18.8%, blah blah blah. But This is where it gets back to those Medicare brackets. So forget about that example for a second. Let me just show you this. If your income is above, let's use a married couple, for example, that's the second column here, above $206,000, your Medicare will cost you more for the year than if it was less than 206,000 for the same coverage. And it's more punitive than income tax. I just gave you that income tax example because if you go $1 over that threshold, you're kicked into that new premium amount. Okay? It's not prorated. There's not a percentage. $1 over means you're in the next bracket. Okay? Which is, if you go from the first bracket here to the second, it's a difference of $69.90. Let's call it 70 bucks a month, okay, per person. So if you're a married couple, that's now 140 bucks a month, right? Because it's per person. So 140 bucks a month extra for the same coverage you were going to get at a cheaper rate just because your income went up $1 from 206,000 to 206,001. So, and if it goes to the next bracket, then you get the next one. The other tricky thing about this, and it's super annoying, but this is just the way the system works. This is a 2-year look back, meaning when we're looking at these numbers, it's what your income was 2 years ago that matters for your premiums for this year. Now, you don't have to do this. The government does this automatically based off the taxes that you file. But that's not an excuse not to be prepared for it. So again, if you're taking money out of your account or you want to, and you call me and say, "Hey, Anthony, I need this much money," and I say, "Oh, great. That's fantastic. Good for you. Let me see what the best way to do it is." This is what I'm thinking about. Is this money that we're taking out going to put us into the next Medicare bracket 2 years from now? Because again, that's the way the system works. I wish it was simpler than that. It's sort of annoying, but that's how it is. Um, so sometimes, even if I discover that, yeah, if we take the money out, it is going to put us into that higher bracket, sometimes we still do it. Sometimes it's worth it. Sometimes it's for a car or something that we need. And it's like, well, yeah, you're going to have higher premiums 2 years from now, and we'll just deal with it. And you can take money out to pay for them if you need to. And that it is what it is, right? These are the laws. We can't change them, or Congress can, but we can't. We just got to deal with them. But if you have other types of assets, like a Roth IRA, like a non-IRA, like a taxable account, that could potentially allow us some flexibility to get you the money you need without having you go over this next threshold. And that's what I'm trying to do. So again, you may hear this and say, "Great, Anthony, you're on top of it. That's what I care about. I'll let you deal with it." Good, that's what we do. But don't forget about this stuff, especially if you're kind of doing things on your own and you're not working with an advisor. Again, if you aren't working with somebody and you'd like to have a conversation, happy to do that. But if you're working on your own, these are the types of things you need to think about. So we think about them for you, or again, if you're doing it yourself, you need to think about it. There's also an increase in price for Part D, the drug coverage. Same exact bracket, same exact principle. Obviously, the increase is smaller because D is cheaper to begin with. But if you're going from, again, the lowest bracket to the next one, it's another 13 bucks a month per person. And okay, 13 bucks a month. Hopefully that's not going to bankrupt any one of us. But 13 bucks a month over years plus the 140 for the Part B premium, that adds up. I mean, we're talking thousands of dollars here. Thousands of dollars that you would not normally have had to pay if we could have avoided that in the first place. So really important to think about this stuff, often overlooked. Believe me, this is often overlooked by people when they think about their income taxes, where it's not just about your income tax, it's about all the other taxes that are based off your income tax. So the key to managing that effectively is we got to plan how and when we're going to use taxable, tax deferred, or tax-free assets. Let me explain what those are again. Taxable is your bank accounts, your checking account, although those aren't great examples because they don't necessarily earn a ton of interest. Savings accounts are a little better these days. But your non-IRA investment accounts are called taxable accounts. What we have to think about there for taxes are dividends and interest that you receive are taxable in the year you receive them. And then if you sell something for a gain, those gains are taxable. That's what it means by a taxable account. By the way, if you're curious, hey Anthony, dumb question, but what are my accounts? Are they taxable? Are they non-tax deferred? Or are they tax free? Just send us a note and I'll give you a breakdown. It's super simple. We deal with it all the time, but not everybody deals with it all the time. So that's why it's easy for me to say. And don't be ashamed if you don't know. I saw a question come in. Is the increase permanent or does it drop the next year? Great question. Great question. The answer is it is not permanent. If your income drops again the next year, you will go back to, let's say, the lowest tier again, if that's where you were in, or whatever tier you should be in. So if one year you have a crazy high income, and then, yes, okay, I'm going to be in a higher tax bracket for, or not just tax bracket, but Medicare bracket for that year. And then next year it goes back to normal. Your premiums will also go back down. And again, remember, it's 2 years from now that they'll go up. And then the third year from now, they'll go back down. Great question. The other thing I will say, and I sometimes don't even like to say this, but I kind of have to if you have a weird year income wise, and weird being, hey, our income was super high this year. We sometimes see it when people retire from like Hennepin County, for example, where they get their vacation and sick time payout, and it's a big chunk of money all at once. If that happens and your income goes up for one year and it's a one-time thing, you're like, look, this is a weird year. My income's really high. It is possible to appeal to Medicare about your premiums for 2 years down the road and say, look, it was a weird year this year. I don't want to be penalized on my Medicare. And it's not a penalty, it's just an escalating premium. But I don't want my premiums to go up. And look, I'll send you whatever information you need. I want to appeal this, essentially. I used to never bring this up because from what I had heard, it was basically impossible for them to grant you this appeal unless you literally just wrote an extra zero on your tax form when you were typing in your income and it's just a typo or something like that. And then I had somebody we work with who had exactly that situation. It wasn't a typo. It was, hey, we just had a weird year. Sent, did the appeal, and the appeal was approved. And I've talked to actual Medicare brokers about that, and I've said, "Hey, we had somebody who's had an appeal who that was actually approved," and they're like, "Really? Like, oh my God, that's amazing. How did they do it?" And I'm like, they just did it. Like, I didn't do it for them." So I bring it up because it is possible. Again, from what I've heard, it's extremely unlikely, but if it's something again where it was sort of unforeseen or it's this one-time payout maybe of your sick and vacation time, you might be able to get it appealed. If it's just no, I needed to take out more money because I wanted to do this stuff, they're not going to grant an appeal for that. I'm pretty confident. But the answer to the question, because I digressed for a minute, is yes, it will go back down. It will adjust year to year. And these brackets, these income amounts change every year. So they do go up usually every year. So it gives you a little bit more breathing room as time goes by too, to be under them. So really important question. I should have mentioned that as we went through that. So I talked about taxable assets, tax deferred, that's your deferred comp, traditional IRA, anything you contributed that was pre-tax. You never paid tax, came out of your paycheck, or you got it to write it off on your taxes for that year. You're gonna pay income tax on that when it comes out. And then finally, tax-free assets life insurance, depending on the type, could fall in there, but primarily we're talking about like Roth IRAs, stuff that you've already paid tax on, and now it's tax-free going forward. That's what I'm generally thinking about a tax-free. But if you've got all three of those types of accounts at your disposal, we can really get in and minimize the taxes you're going to have to pay to get you the money that you want to get, right? So that's the key. Um, as far as taxes go, let's assume you're a couple who do have all three of those different buckets, okay? So Sam and Mary here, they both have IRAs, they both have Roth IRAs, and then they have a joint bank account. So again, the IRAs up at the top, those are the tax deferred assets. The Roth IRAs are the tax free assets, or I should say, how did they describe it? Oh, they use tax free. You'll hear tax free, or you'll hear like there's other terms for it, but I would call it tax free Roth IRAs. And then a joint bank account, which is that taxable example. What order should they spend these? in a vacuum, because again, it's going to be different depending on everybody's situation. Where's there, do they have two social securities and two pensions? Well, that might change the calculus, right? But in general, how would you do this? And I agree with this conventional wisdom. Spend taxable money first, bank accounts. Now, that doesn't mean you drain them down to zero necessarily. It just means if we're looking for the next dollar, we probably look there first. And then again, somebody like me takes a look at, does that make sense tax wise? What are we setting ourselves up for in terms of Social Security, in terms of Medicare? I do all that stuff for you. Next, tax deferred money, IRAs, deferred comp, 401k. That's probably the next place we look at. And the tax exempt money, that's the other way to say tax free, last. And that would be the Roth IRAs. And why do you generally want to spend Roth IRAs last? And again, generally, not true for everybody. This isn't one size fits all necessarily. But you generally want to wait on Roth IRAs because the benefit of the Roth IRA is that it grows tax free. All of the growth in a Roth IRA is tax free. So the longer you let it go and grow, the more growth you're getting, in theory, the more tax advantage you're getting by having more dollars that are tax free. That's the line of thinking. Now, are there reasons to use a Roth IRA sooner? Absolutely. Let's again do the example of Medicare, where, hey, if we take out another dollar from our traditional IRA or our deferred comp, we're going to be paying 140 bucks extra every month for Medicare. Maybe then we take out a little bit from the Roth just to keep ourselves under that bracket. That would be totally reasonable. But it can be a case by case thing. So there are a couple adjustments though. And again, this is where it gets specific to you. An alternative approach would be spend taxable money first. Still, that's number one. But did you know that you can convert pre-tax IRA dollars to Roth IRA? And if you do that when you're in a particularly low tax year, it could be a really advantageous move. Okay. So what this is introducing is the concept of Roth conversions. And yeah, this slide breaks it down, I should say. But let me take you off my background for a second and just tell you how this generally works for people. Especially for people who work for Hennepin County, state of Minnesota, any public institution where you have a pension. Okay. And again, if that doesn't apply to you, you can still do Roth conversions. This is a common scenario we run into. So you retire from your job and you're on your pension right away, but you're deciding whether to take Social Security yet. Maybe you're either too young to take it, period, or you're just, yeah, I want to wait. I want to see if I can wait till 67 or even 70, for example. Again, case by case, but let's just say that's you. In those few years, after you retire, while you're living off your pension and maybe some of your investment assets, you will probably be in the lowest tax bracket you're going to be in for the rest of your life. Okay? Because you're not getting Social Security yet, but you're getting a pension, but that's probably not as much as your gross income was from the job you just retired from, where you were probably at the top of your earning potential there. In those relatively lower income years, should we convert money from your deferred comp into a Roth IRA and pay lower taxes? When you're converting money to a Roth IRA, you're making a decision. And the decision you're making is, when do I want to pay taxes? When? So not if, but when. Do I want to pay them right now? That would be an argument to do the Roth conversion if the answer to that is yes. Hey, I'm in a lower bracket right now than I've been in for 20 years. Can I pay any taxes now versus later? Probably you can. Or do I want to wait and pay them later because I am still in a high tax bracket? I tell, for all the public employees that we work with, you'll hear me say this a lot, where you've got the blessing and the curse of a very stable income. And what I mean by that is if you've got a pension and you're eligible for Social Security, you've got probably a very stable income from when you retire or before you retired, after you retired. It's probably going to be pretty level, which means that there may not be an obvious time to do a conversion like this. But there may be a good time. You may have a dip one year in income that we can take advantage of. And what you need to know about conversions are that it's taking money from pre-tax to Roth and you can do it at whatever amount you want, but whatever amount you convert is taxable in the year you do it. So one of the common strategies we employ is you'll hear it called filling up the bucket. And I'll get out of the way a little bit here. Um, so what that means is, let's say you are in your top dollars income wise are in the 22% tax bracket, the income tax bracket. You've halfway filled up your allowance within that bracket. Well, if we're already in that bracket, why not go up to the top? Why not say, hey, I've got $20,000 more until I would even reach the top of the 22% bracket and then go into the 24? Why not convert that 20,000 from pre-tax to Roth? I'm not going to pay any more in taxes than I'm already paying on my top dollars. And now I've got Roth assets going forward that will grow tax-free. It's even more powerful if, for example, you're in the 12% bracket, because what you're looking at is the difference between the bracket you're in and what the next bracket would cost you if you went into that one, right? So the difference between 22% and 24% is 2%. So you could say, well, I'm saving 2% on every dollar I convert. And okay, that doesn't necessarily add up to a ton of money. But if you do it year over year, it can add up to a lot of money. It's even more impactful, obviously, than if you were in the 12% bracket versus the 22. Now you're saving 10% on every dollar you convert. Now, a lot of people hear this and they go, that sounds like a no-brainer, Anthony. I mean, I'm already retired, but should I be looking at it? And the answer is absolutely, we should look at it. But there's a couple things that make it a little bit trickier to decide whether it's absolutely the right thing to do. One, we've already talked about Medicare, right? So every dollar you convert also adds to your income for Medicare purposes. So we don't want to go over that threshold, even if we have a ways to go in your income tax bracket. Again, I can help you manage that. So that's just another variable to keep track of. The other thing that makes this tricky is what this whole project, Roth conversions, depends on is where tax rates are. And it would be a lot easier if we knew tax rates were locked in place. But of course, they aren't. Tax rates themselves can change in the future. So when we're making that decision, again, a Roth conversion is a decision, we're deciding that paying taxes now is cheaper than paying taxes later. But what if tax rates change, right? What if they go up in the future? Well, then it's even more a reason to do a conversion now. I'd much rather pay them now if I think rates are going to go up in the future. But what if they go down in the future or the system changes and they would go down for you? Then we've paid taxes maybe at the not most advantageous time. So it's not a perfect science. We're just doing the best with the information we have. But in general, we should be thinking about this on a year by year basis, is my at least thinking about it. Is there question came in? Is there an income max that can limit if someone can convert IRA to Roth IRA? No. Good question. So income can limit your ability to contribute to an IRA or a Roth IRA. That's true. If you're over certain income thresholds, you can't contribute to those. You can, but you don't get any tax benefits for it. But conversion, no limits to that as far as income goes, because converting means the money's already been in a pre-tax account. So essentially, you've already shown that you were eligible to contribute that money. Now we're just deciding when we want to pay the taxes on it. So what that question leads me to is there is no income limit or anything like that. But when people who are nearing retirement ask me, should I be saving more to Roth or to pre-tax? And I kind of give them the same info I've just laid out here. Well, it depends on what tax rates are and blah, blah, blah. But what I say to them is, well, I know two things probably for certain. One, if you're just about to retire, you're probably in your top earning years, right? You're probably making more money now than you've ever made before. So you're in your top tax bracket you might ever be in, right? And we don't know that for sure, but it's a good guess. And secondly, whatever you can contribute to pre-tax right now, you can always convert to Roth later. So even if your income tax does stay the same and that it really didn't matter one way or the other, you can contribute pre-tax now and then convert it to Roth later. And you don't have to be working. You can do this when you're retired. One thing you should know, you can't convert directly from deferred comp to Roth IRA. You got to hit regular Roth IRA in the middle. So it's totally possible. It's just one extra step. So in other words, if you have your deferred comp, you have to roll the amount you want to convert at least into an IRA and then convert from an IRA to a Roth IRA. By the way, IRA stands for individual retirement account. So the rollover from deferred comp to regular IRA doesn't cost any taxes. It keeps all the money the same tax status. And then from the IRA to the Roth is what triggers the conversion. That's when you pay the income taxes, all that stuff. So again, heard as you've heard me talking about this, you're probably imagining correctly that yeah, this can get complicated pretty quickly. But it's something that we need to be thinking about. It's something that I think about a lot, and it's something we need to be talking about as to whether this makes sense for you or not. And again, if your income's very stable, oftentimes it doesn't make sense. It's like, yeah, you could pay taxes now or you could pay them later, but you're probably paying the same amount either way. And then it's like, well, it's kind of up to you then. There's no real tax reason. But at least we need to think about that, it would be my point. Um, Roth conversions in years with unusually low income can be beneficial. Here are some examples. Medical bills are one that people don't think about because if you have really high medical bills and you happen to have a really low tax year because you're able to write all that stuff off, that could be a year to convert money because wow, I'm in the 10% bracket this year because I had so many medical bills, which I hope no one on here has medical bills like that. I mean, I prefer not to have them in the first place. But if you do, we could try to use them a little bit to our advantage here. Or the biggest one is after retirement, but before receiving Social Security benefits, pensions, or IRA, especially Social Security. That gap between the day you retire and the day you turn on Social Security, that window is prime Roth conversion territory. Um, I'm going to switch gears a little bit to charitable giving. Okay. And the idea is how can we maximize the tax benefit for charitable giving? Did you know that I'm going to guess most, if not all of you on this call who give to charity and you're just writing checks from your checking account to give to charity, most of you are not getting any tax benefit for that. Some of you might be. So I know some of you who are and know about what I'm about to say are like, no, I thought about this, Anthony. We still are. That's good. That's not a bad thing. But the reason why I'm confident most of you aren't is because most of you are taking the standard deduction when you do your taxes. So let me back up and explain what that is. The little Al and Shirley over here is a actual number example, but let me explain the concept. When you file your taxes, you plug in all your income, and then if you're doing it yourself on the computer or through TurboTax or you have a preparer, they're then taking your total income and they're comparing what you can deduct from two categories. The first category is the standard deduction, and as the name implies, that's what everybody gets. It's a flat number. If you're married, you get twice as much as a couple as an individual does because there's two of you. But the standard deduction for a married couple in 2024 was $32,300. So you get to write that much off of your income tax bill no matter what you did during the year. Even if you didn't have a single itemized deduction, you get to write off 32,000. The only way that your itemized deductions matter is if they add up to more than 32,300. And unless, again, there were medical bills or some weird year, most people these days, the statistics are saying that it's less than 10% of people, well less than 10% of people, are actually getting a benefit by itemizing here. You're better off just taking the standard deduction. What does that mean? Well, for charity, again, if you're just writing a check out of your checking account, that would be an itemized deduction. But if your itemizations don't add up to more than 32,300, you're better off using the standard, which you would have gotten whether you gave to charity or not. So this is not an argument not to give to charity, by the way. Obviously, the most important thing is that the money goes where you wanted it to go. But what I would prefer is that it goes where you want it to go and you get a tax benefit for it. So let me explain. There's a couple tools we have in our arsenal to help with that. Um, One is qualified charitable distributions, or this is really the main one. Okay. And this is the key caveat here is you got to be older than 70 and a half. So if you're under 70 and a half, I'm sorry, you're not eligible for this yet, but you can look forward to it once you are. Okay. Through your IRA, and again, you can only do this through an IRA. So if you have deferred comp, this might be a reason why you consider rolling over to an IRA, which again doesn't cost you any taxes to do. It's tax neutral. But you can give per year up to $100,000 from your IRA to charity per person, 100,000 per person. Nobody we work with is giving $100,000 a year out of their accounts. We have some very generous people who are giving a lot. Nobody's up to the max. So it says up to 100, you can do any amount below that. Okay? It must go directly to the charity. Now, we can mail you a check, but the check is going to be made out to the charity, not to you. And that's key for tax purposes, right? If I just sent you money from your IRA and you said, well, yeah, I'll forward that on to the charity. I'll write out a new check after depositing it in my bank account. The IRS is going to look at that and say, that looks like it could be exploited pretty easily, right? How do we really know you sent that money to the charity, right? So it's got to be made out directly. So it's a form to fill out with us if your money's with us. And it not only donates money out of your IRA pre-tax, meaning that money which you earned through work at one point, and so you didn't pay tax then, is going out without having to pay tax. So that money has literally never been taxed. That's one good thing. The other good thing is once you have to take these required minimum distributions out, which don't happen until you're 73 under current rules, and eventually it's going to escalate to 75, it will count toward that number as well. So if you're not familiar with required minimum distributions, what those are is every year once you turn 73, you have to take out a certain amount of money from your accounts. It's a formula, it changes a little bit every year. We help you navigate all that when you get to that age. So if you're younger than that, I'm happy to go into more detail. Actually, we did an entire RMD event earlier this year in January. If you're curious, go to our YouTube channel and check that out. I go deep into RMDs. But it's an amount you have to take out. And the reason you have to take it out is so that you get taxed on it. That's why they make you do it, the IRS being the they in this equation. So if you donate some of that money to charity, it counts towards the amount you have to take out, and you don't have to pay taxes on it. So now what you're doing, going back to the example here, is you can take the standard deduction on your taxes, get the full regular benefit, and not have to pay taxes on the amount that you've donated to charity, right? You can get a tax benefit for that as well. So it's kind of like getting the best of both worlds. So even if you are currently able to itemize, and you're like, yeah, between our charitable giving and our other deductions, we do beat the standard deduction. Are you only beating that deduction because of your charitable giving? Because then what you could do is you could do your charitable giving through your IRA and take the standard deduction. Now you're getting even a bigger amount of tax savings there. So again, you have to be 70 and a half here, but we need to remember that this is an option, okay? Because, or I will help remind you if you work with us, but it's a great reason to work with somebody like me who can watch this stuff for you. This is just a quick reminder. If you took money out of your IRA and gave it to charity without doing a qualified charitable distribution, yet say you want to donate $5,000, or you had to because that's your required minimum distribution. $5,000 is taxable. Depending on what tax bracket you're in, you actually had to take out, in this example, $6,200 just to get $5,000, right? So you donated $5,000 to charity, but you had to pay $1,200 in taxes to do it. Versus if you do the qualified charitable distribution, you take out 5,000, the charity gets 5,000, you pay $0 in taxes. What that actually means is you might be able to donate slightly more than you were before because you don't have to worry about the tax part of the equation. So that's another way to look at it. Everybody's different. I tell people, look, if you want to, if you're just at like a charity drive and they're asking for cash donations or somebody to write a check real quick and you just want to do it, don't feel bad about doing that. Don't feel like, hey, I'd love to donate to you, but I got to go call Anthony and fill out this form, and the check will be in the mail, and you'll get it a week from now. You can do that, but don't feel bad about taking the checkbook out and just writing it. Again, the most important thing is that the money gets where it wants to go, or where you want it to go. But if you're a regular giver and you do stuff every year, let's do it through your IRA because it's going to be more tax efficient to do it that way. And again, an IRA you can move your deferred comp into an IRA, and that's a common reason why people consider that among the other reasons there are to do that. Um, Hope to have assets to pass on. How does this work? Once you're no longer here, what about taxes? And you may say, and it would be fair to say, hey, that's somebody else's problem, Anthony. I don't have to worry about taxes. And okay, to an extent, I agree with you, but it's important to know the rules, if for no other reason, so that you can have the people who are in line to inherit some money know the rules. Okay, so this is what's on the screen right now is something that is very often overlooked, by the way. Let's say you're a married couple and you have a joint account, whether it's well, it would probably be an investment account in this example. I'll explain why. And it's worth $120,000. But let's say you bought those investments for $100,000. So you have $20,000 in gains in that account. And so, in other words, if you as a couple, this is a joint account member, were to just call me up and say, hey, Anthony, we got this account. We're buying a cabin. We need all that money. I'd say, hey, that's fantastic. We can sell all 120,000 worth of your investments, get you $120,000 in cash. However, you're going to pay tax on that $20,000 of gain there because that's how the gains taxes work. Whatever you gained, you pay taxes on. And it's not even income tax, but I won't go into that because that's not what this example is getting at. However, in this example, again, I hope this doesn't happen to anybody, but life does happen. One of the spouses in the married couple is diagnosed with a terminal illness, 18 months to live. Well, there's a big difference for what we could do next. So scenario one, we do nothing. The account stays a joint account, and what happens is the wife in this case, Mary, inherits half of the joint account, and there's a step up in basis, eliminates the long-term gain on part of the account. So in other words, it's a joint account. It's worth $120,000, but because there's two of you, each of your parts is 60,000. Just divide the total number in half. When someone dies with a taxable account, you get what's called a step up in cost basis, meaning whatever the value of your investments is now, the IRS says, hey, we're just going to treat it like you bought it for that price. You have no more gains to worry about. So, in other words, again, really oversimplified example, I bought Apple stock for $10 and it's worth $100 now. If I sell it, I pay tax on the $90 of gain. If my kids inherit it, or my wife inherits it, she pays zero taxes because the IRS says we're going to treat it like you bought it for 100. That's the step up in basis. It's a tax benefit upon inheriting something. But because this was a joint account, Mary only inherits half of the account, right? Because she already owned the previous half as a joint owner. So she only gets half a step up on the cost basis there. Versus if after this diagnosis they were to move all the assets into Phil's name because they knew he didn't have a long time to be here, she then inherits the entire account and gets a step up on all of the assets. Now, this is a specific example where there is a timeline for who is going to meet their demise, I guess, in this case. Again, I hope we don't even have to think about this. I'd prefer to not have to have a conversation like this. But if we can reasonably believe that there's a good chance one party of the couple will pass away before the other, this is a proactive move we can make to save in taxes for the survivor in the long run. So it's something that's often overlooked. And it doesn't mean that if you have a joint account right now, you should say, "Ooh, let's move all of it out of a joint account," because the key part of this equation is we don't know who's going to go first. And if you do it the opposite way, you can lose out on some tax benefits. So it's in a situation where we kind of have a roadmap for how things are going to play out. We can try to reduce taxes, and that'll just ease a little bit of the financial burden there. Obviously, we're getting a little bit morbid here, and I'm sorry about that, but these are things I have to think about. Um, so when you go to sell your investments, this is an obvious question. This slide shouldn't even be in here. Obviously, you'd prefer to pay less taxes or no taxes if possible. That's what that was asking. All right. Next thing about inheriting. Okay. And I promise I've hit you with a ton of information. We're getting close to being done here. So I thank you for your patience. Um, if the next generation, or this applies to you if you're inheriting it from a parent or a friend or a family member, if you inherit an IRA, pre-tax money, there are separate rules for it. There's no step up in cost basis because, again, an IRA, you pay taxes as income when you take the money out, and so will the people you send it to when they inherit it. The key is, so here's an example. I'll use this example here. Pam, 65 years old, son Kyle is 40 years old. Pam dies and leaves her IRA to Kyle, 100%. So he inherits all. It's $400,000, 6% average rate of return. That's just important for assumptions here. Scenario one, Kyle takes distributions over 10 years. So when you inherit an IRA, there's a new rule. This was put in place in 2020 where you have 10 years to cash that account out, okay? From whatever the balance you inherit to zero. Now, that doesn't mean you have to spend it all. You could resave it into a different investment vehicle, but you got to take it out of the account. Why do you have to take it out of account? Because that's what triggers the taxes. That's why they make you do it. Um, so, what we recommend is that people take it out in 10 equal increments to spread that amount over as many tax years as possible. Okay. And we can work with your kids, for example, to help educate them to make sure that they understand that if you work with us. But doing it that way is the smoothest way to do it versus doing it all in year 10 and forgetting about it until then. And then what Kyle, so if he does it year by year, Kyle would have to take out $54,000 a year. And again, he should be so lucky to have to pay taxes on the amount he inherits, right? That's how I feel about it. But he should do it in a way that maximizes the amount he actually gets so that the inheritance you've left him isn't just going to the federal government for taxes, right? We want that money to, as much as possible to go to him. That's what you wanted. So if he waits till year 10 and he makes a 6% rate of return on $400,000, well, now he's got to take out $700,000 in 1 year. Well, he's definitely going to be in a higher tax bracket, right? He's going to be in one of the top tax brackets, if not the very top one. So now he's really screwed himself. He's paying double digit percentage higher in taxes than he would have if he just took it out gradually. The other key piece of this is if the person you are inheriting the IRA from was already taking required minimum distribution, so they were older than 73 right now, or they're certainly in their mid to late 70s, early 80s and above. If they were already taking RMDs, you also have to take an RMD every year. We help you calculate that. You'll probably want to take more than the minimum amount. RMD is required minimum distribution. You probably want to take more than that. You want to take 1/10 of the account out. But you still have to take something out. You can't wait until all 10 years are up to do what Kyle is doing here. The only reason Kyle could wait all 10 years is because his mom was only 65 when he inherited it. She was not doing required minimum distributions yet. So he gets the option to wait. I still wouldn't recommend waiting in most circumstances. Okay. Goodness, how will we ever manage this? I hope you're not sitting there like this, like, oh my God, you've just introduced so many more problems to me, Anthony. The way you will manage it is you'll have somebody help you, ideally. Somebody like me, somebody like an accountant as well. These are the four stages of retirement. These are some good checkpoints. Again, we help you deal with this. Pre-retirement, know how your assets are going to be taxed when you take them out and consider funding Roth accounts. Early retirement, you're going to be going on Medicare and Social Security most likely. How do we manage that? How do we make sure we're not paying more than we would have to for those benefits in taxes? And then fill tax brackets in low income years, whether that's through Roth conversions or through other methods. Middle retirement, you're going to get to those required minimum distributions. Let's do them efficiently, maybe through some charitable giving. And late retirement, we're going to organize your assets for tax efficiency to the next generation. Although, again, I definitely subscribe to the they should be so lucky model of inheritance. So, if you would like to go through this with us, I'm wrapping up now because we're at the top of the hour. Please let us know. We can go through your tax situation from A to Z from the investment perspective. Again, I'm not an accountant, but we can go through and I can show you how each of the topics that we've talked about today could impact you specifically, or whether they really don't impact you and you can kind of just put them out of your mind. Qualified charitable contribute reminder, qualified charity, this was a question that was asked. Qualified charitable distribution counts towards adjusted gross income. Yes, and one of the things I should mention that is true. It counts towards your adjusted gross income. However, you don't pay taxes on a qualified charitable distribution. So it's a little bit different than, $5,000 of part-time work going towards your income versus $5,000 of qualified charitable distribution. Um, why that is because when you take this qualified charitable distribution and it's counting toward your RMD, your required minimum distribution, the IRS still has to know that you took out the right amount from your account. So it's a weird thing for those of you who have done qualified charitable distributions before, you know this, but if you haven't yet and you're thinking about it, the first year you do them, it's going to be weird. And people always look at me funny when I say that, and weird really is the best word to describe it. Um, when you get your tax statement from us or from whoever that says, hey, this is how much you took out of your IRA last year, it'll say the full amount, including the charitable distribution. And it has to because that's what the IRS needs to know that you took out the right amount. Um, but you'll look at that and you'll say, oh my God, we screwed this up. Anthony screwed this up. You'll call me. You'll say, hey, I thought this wasn't supposed to be taxable. You said this wasn't going to be taxable. And now it's on my tax statement. What gives? And I'll say, I agree. I don't like how they report it. This is how they report it. But the answer is they have to show that you took the money out. It is not taxable. There's a line on your tax form, and any good accountant or preparer will know exactly what it is, or even you can do it yourself, where you type in, this is how much I took out. This is how much of that total was taxable. And the first year you do this, it feels weird. It's like, is this the honor system, Anthony? Is this how taxes work? And no, there are ways to verify it, and I can go through that. We actually created a guide for people for this because it's becoming so common now, and people always have questions about it. But just, it's going to be weird the first year. Nothing's wrong, nothing's been screwed up. It's just the system itself is a little strange. Personally, I think it's because qualified charitable distributions just weren't super popular in the past, and because of tax law changes, they are more popular now. So the system hasn't updated to be more streamlined, but that's just my 2 cents on it. But yeah, there's a couple things with it that you'll get used to it after you do it for a year or two, but it's weird the first time. So no, I just tell people be ready to be like, "Ooh, did we do this right? We did. I promise we did. We do it right when we do it." So that was probably more of an answer than you wanted for that question, but I wanted to digress into that. So, okay. If nobody has anything else, we're six past top of the hour. I appreciate everybody's patience. I will talk to you when I talk to you, and if you hit yes that you wanted me to follow up with you, I will be reaching out, or Aaron will be reaching out to set up a time for us to talk here. So, thank you, everybody, and we'll see you next month.